Hey, Rob, welcome to the Virtual CMO podcast. I'm so glad you could join us today.
Pleasure to see you again, Eric. Happy to be here.
You are now officially my second guest from the Netherlands, so slowly working my way around the globe with different guests. Excited to have you here. We live in obviously this digital age where the world is so small we can connect with everybody as long as the time zones work and you can get on somebody's calendar. So it's great to have you here.
It's a pleasure, and I'm honored to be the second Dutch guest, although I'm very curious who the first one was.
Yeah, so okay, you're going to put me on the spot because I don't actually remember her name right off the top of my head, but she was actually a guest on one of my other shows where we talk about work-life balance, and yeah, it was a very fascinating conversation. But today we're going to get into a conversation that we really haven't had that often on this show, and I'm really excited to dig into it a little bit because we talk on this show about marketing, especially for small and medium businesses, and really what it takes to accelerate your growth and the kind of tactics that you can employ to become better at what you do. But that comes at a cost, right? It comes at a cost of dollars and cents and being able to employ the right marketing tools, the right marketing tactics. And I think for many people, there's mystery around that. There's mystery around how to set your budget. There's mystery around what metrics to track. There's sort of a mystery around, what's a good statistic and what's a bad one. And so, yeah, I'd love to just start out and get a little bit of your background. How did you get into this? How did you get into tracking financial metrics and insights?
Well, my background, I studied finance and strategy in university. So that's where I went off track because I got the passion for the finance and strategy combination at that age already. Started my career in banking, got sent to China as an expat for a couple of projects there, fell in love with the energy and the entrepreneurship in China. So I did what any sane person would do is I quit my job and started the entrepreneurial journey there. For 7 years, together with a partner, I ran a technology and investment firm, which was a really interesting experience, but it took me 7 years to realize that as a foreign company without very deep pockets, you're never going to make it there. So when I realized that, I figured, you know what, I'm going to step out. I'm going to go back to my original passion, and that is the pure finance side. And I started, as again, most people would do in their entrepreneurial journey, as an independent consultant. Advising startups and scale-ups as they're on finance, on fundraising, on reporting. And 9 out of 10 times, the first question I would ask is, show me the reports, show me your books, show me your metrics, show me your dashboard. Where are we? Like, where are we in your journey and where do we want to go? And almost every time the answer was, well, we don't have any. That's why we want to talk with you. Which, of course, is a very nice compliment to get. But it also doesn't really make a lot of sense that you start paying a consultant at consultant rates to do something that is so foundational for your business.
Yes.
So after a few years, I finally figured out how to productize it, how to systematize it, to set up reporting and analysis as a productized service, and actually drag in the right people that are even better at parts of the numbers than I am, and let them actually do the accounting, do the reporting, and I still do part of the analysis because, well, that's where my passion is.
So for a lot of businesses, they have to have some accounting system, right? They have employees, they need to pay people, they need to pay vendors. So there is at least some level of accounting, whether it's very basic in an Excel spreadsheet or whether they're using a Xero or a QuickBooks or some sort of a tool to basically do that. But I'm sure as you get into these businesses, you find what so many of us entrepreneurs run into. It's data in, but you just don't necessarily know how to make sense of it all.
True. That's the most common problem. And it starts already at the problem lies on two parts. One is the data quality is usually subpar, to put it friendly. So either the founder does it himself and therefore tries to maintain the books at a low cost, but actually it's becoming more expensive because you miss out on all the information and it takes the time of the founder.
Yes.
The second thing is that the data might be so overwhelming or so scattered that it becomes really hard to identify like what are the numbers you really should be tracking. And there's a big difference if you're trying to build a Tesla level moonshot or a 4-hour workweek business.
Yes.
The things you got to look at and the meaning of the numbers is completely different. So you have to start, and that's usually actually the most difficult part, with what are you trying to build? What are you trying to achieve? And then you got to figure out what numbers fit that trajectory, which numbers fit that goal, and where do you get them?
Do you find it challenging working with businesses because you mentioned that you work with startups, and many times early stage businesses, they're running in debt, right? You know, their financing usually comes from some debt offering. So money is piling up in the debt column, but yet you need to spend that money. That's part of what happens. And then at some point, hopefully you achieve profitability, and now all of a sudden you're spending profits, right? The equation turns green and you're spending differently. Do you think businesses have a hard time making that adjustment as to what to spend as debt and what to tap into once they get to profitability?
I think there's in general a massive gap between the source of funding on the one hand, so the right-hand side of the balance sheet on the one hand, and how to utilize that money on the other side. So we work with a few startups, but we now mainly work with bootstrap scale-ups. So companies that didn't have any external funding, that are completely bootstrapped and reached a certain scale where they actually need to get it more in place. For them, and that's usually because they fully own the company, those owners are either overly optimistic and spend everything immediately and take way too much risk, or on the other extreme, they are so conservative and they are so worried about running out of money that they're under-investing in the growth. But in both cases, there is this massive disconnect between the amount of money they have on the balance sheet, the runway, like the operational cash flow that they are realizing. So are they actually making money already or not? And how much they're investing in growth. Those things seem to be completely disconnected in their heads.
Do you see some consistency with businesses that they either overinvest in product development, overinvest in people, so they bring too many people on too fast, they overinvest in marketing, they're spending money in ways that they can't make good attribution towards to see what's effective and what's not? Do you see some commonality, some common business mistakes?
There's one really consistent pattern. The company over-invests in whatever the background of the founder is.
Oh, interesting.
So if the founder is a product guy, usually the company over-invests in product and product development. If the founder has a marketing background, they're over-investing in marketing and under-investing in operations or products, etc. Because that's where the bias of the founder is. That's where their strength is. That's where they understand how to do it. So that's where they focus.
That's very interesting, and I can see how that would play out. What about in human capital? Do you find that people bring employees on too early? Have things really changed in this digital economy where there's so much freelance talent out there? How have you seen sort of the human capital side of the equation?
I don't think I have seen a really clear pattern there. There too, it seems to fit with the personality of the owner, of the founder. We work with a couple of agency owners that are super risk averse. And so for them, we've been pushing them like, hey, you have the runway. Maybe you should hire an executive assistant. Maybe you should hire another marketeer because you have the cash, you have the bandwidth to do so. And it would allow you to free up more time and grow faster.
Okay.
On the other hand, there's another agency owner that we work with who has hired so much and so fast that he could double his revenue and still has overcapacity. But he is aggressive, overly optimistic on his sales, so he keeps pushing. So I don't think we've seen a overarching trend in the last year there. No.
Well, that's interesting because I do think, things have changed in the economy and you can get resources part-time, you can get overseas resources. There are many ways to bring people on. And yet I still see a lot of reluctance on companies to invest in that, even though that does provide some of the scalability and growth. So it's interesting to see your perspective on that.
Interesting. Well, one difference might be we work with companies that are usually already set up completely remote or completely distributed. So working with contractors and part-timers is something that they are quite familiar with. I can imagine that if you're more office-based and the work from home transition last year opened up that whole world. Yes. I can imagine that is like an eye-opener moment for them.
Mm-hmm. Well, we were talking about metrics earlier, and one of the things that's always surprised me is, many entrepreneurs, they've got somewhat of a business background. Maybe they've got a business degree or a master's degree in business. So they've probably taken some level of accounting classes, right? So they know that there are debits and credits, and they know what a balance sheet is and a profit and loss statement, et cetera. But oftentimes, at least in my experience, that was a very mechanical set of training and education. It didn't really teach you what the numbers meant. It just taught you how to sort of balance everything out so the books were technically correct. Do you find that as well, that people look at the numbers, but they just don't really understand what they mean?
All the time.
Yeah.
To be honest, that is our license to operate, because it's that translation that we focus on. They get the P&L from the accountant. They look at it and they think, it's more, all the numbers are higher than last month. That must be good. That's it. So, and that's a shame because there is a lot of value in there. And one of the things that frustrates me, to go on a slightly different angle.
Yep.
Most of these companies that we work with, they have one revenue line. So in their whole P&L, there's one line revenue, and that needs to go up. They don't break it down over different client groups, different projects, different service lines, or different, whatever the different geographic areas, whatever the relevant breakdown is for them. So they just look at revenues going up. So maybe the revenue for their marketing services is going through the roof, and while their operational services are declining, but overall it goes up. So they think it's good news.
Mm-hmm.
But one level deeper, there is a treasure of data that if they would see that, you could say, okay, we're going to double down on this marketing part because that's where the growth is. And we're going to scale down or even spin off or cancel the other part.
Mm.
And you can go even more granular, and probably that's where a lot of owners would lose the interest or lose the overview. But going at least one level more detailed than they currently have already unlocks a wealth of information.
Really understanding your numbers, digging down and seeing what makes up part of a category, if you will. I'm curious too, when you work with a lot of these companies, do you find that most of them have profit in mind from the beginning? So they are looking for a certain level of profitability and they build their business around that? Or is it more that profitability is an after effect and wherever it ends up is wherever it ends up, but there's no real design for profitability?
The design is for revenue. And that is one thing we're trying to change. So most people look at revenue as like the indicator for success.
Right.
It's a 7-digit business. It's an 8-digit business. It gives a certain status. And like you mentioned, profit is much more relevant because that's actually where the money gets made. But in reality, we try to persuade them to not look at revenue, well, to look less at revenue, look less at profit, and look more at operational cash flow. Because if you're in a service industry and you have a super big client that has a massive retainer to pay, but they're paying 5 months late, you still have a problem.
Yes.
So we prioritize cash flow over almost everything.
That's so interesting because I think That's something that so many businesses struggle with, right? It's collecting those payments. It's maintaining good cash flow so that they can really fund the business. I think that's what causes a lot of gray hair on many founders, is that it's cash flow issues, right? It's not necessarily having consistent money coming into the business. So what are some tips that you give businesses when they say, I've got a real cash flow problem? What kinds of things do you think they need to implement to better account for that money, to better collect that money?
If you're looking at a service business, the first thing to do is be stricter on your receivables. You probably have customers that have 30-day payment terms and then pay another 30 days later. That's the lowest hanging fruit, to jump on that and get them to pay earlier. For new clients, if you can, and it depends a bit on the market you're in, your power balance in the market, etc. But if you can get clients to pay upfront, so they pay and then you start the service, that's by far the best thing you can do to improve your cash position, because you never have the risk of people not paying, and they pay you before you pay your team to do the work. So in that sense, you can never run out of money.
So it's really structuring the deal in a way that you're getting that money up front rather than having to wait to collect it after the fact.
Absolutely. Because if you've delivered the service and your customer is happy or unhappy, that doesn't even matter actually. But they, for whatever reason, don't want to pay. You have paid your team and you have a zero in the bank from them. So if you can get them to pay up front, your risk is zero. You can grow as fast as you can, because in a lot of agencies, if you grow fast, you need to hire the team, you need to train the team, you need to invest in that. And then you get the clients in, and then 3 months later, they pay. All that time, you are paying before your customer pays you. And that means if you grow, the faster you grow, the more you need to put in.
Yes.
Well, if your customer pays you first, the faster you grow, the more money you have in the bank accounts. Yes. And the lower your risk.
We talk on this podcast a lot about reducing friction, about making things easier. And I've had clients, business owners, who will say, well, I don't want to offer my clients the ability to pay on a credit card, for example, for a smaller kind of transaction, because I don't want to pay that 2.4% or 2.9%, whatever it may be. But yet, if it takes them an additional 3 months to collect the money, because now it's got to go through an accounting process, a check has to get issued, mailed, you have to deposit it and wait for that to clear and everything. There's a cost, there's an opportunity cost there as well. And so it surprises me that more businesses don't build that into their pricing, don't build that into their expectation, because as you said, collecting that money, that's what you want. I mean, you want to make that as easy as possible.
Absolutely. And it's not only the bank hassle, etc. It's also the time and the stress of you or your team to chase that client. If you have somebody who costs $40, $50 an hour, chase that client 5 times per week to pay, that comes with a cost as well. So I would much rather pay that 2% for the credit card fee, hands down. We even advise our clients, if it takes a small discount to get them to pay upfront, for us, that's a no-brainer.
Yes.
I don't like giving discounts. It usually undermines the value, etc. But that's where you guys, marketeers, come in. But from the finance and the risk perspective, pay upfront, even if it comes at a discount.
I'm curious too, when we're talking about analytics, we're talking about metrics and measuring these things. We talked a little bit about tools like QuickBooks, which is very prevalent out there for a lot of small businesses, and Xero and others. What do you think of those tools in terms of their analytical capability? They're tools to be able to really tell you the health of your business. What do you need in addition to that to really get the insights that you should have?
Let me start with a compliment to them, because they have increased that tremendously over the last few years.
Yeah.
It used to be just a boring P&L and a boring balance sheet, and that's it. Especially QuickBooks now adds a fairly decent dashboard. So it already helps to visualize it. What is still missing there is the interpretation of it.
Yeah.
And that's where, of course, we come in, but you as the owner can do it yourself as well, or somebody in-house. But the interpretation of what does this mean? Is a 10% growth in revenue, is that good or not?
Yeah.
QuickBooks won't tell you that.
Right.
But you should know, or somebody should tell you, if in your particular context, given your goals, given your business, if a 10% growth is good or bad. The same with profitability, the same with certain costs. That QuickBooks is not going to tell you that. And everything that touches more on operations and marketing, like your customer acquisition cost or the lifetime value of a customer, QuickBooks is not telling you that either. But for you as the owner, that's absolutely critical to know. So they've made a step forward. And for a financial savvy entrepreneur, that could be good enough because they can make that switch. For those that are not, somebody needs to help, either internal or external, with that translation.
You said something very interesting there too. These metrics that you're looking at, they're very dependent, right, on the industry that you're in, on the products or services that you're selling. There is no sort of universal metric for profitability or margin or whatever. It's very dependent on the industry that you're in. And you sort of need somebody who can help you understand, for this industry, these are some of the benchmark data points that you should be shooting for.
Yeah, although I think people overvalue industry benchmarks. If the industry benchmark for a marketing agency is to have 50% gross profit, if I'm in a highly innovative agency in the podcasting space, for example, maybe I should aim for a much higher gross margin. And if I'm aiming for that industry benchmark, I'm leaving money on the table. Maybe you're in a super competitive market where there's no chance on earth you're going to get 50% gross margin. So industry benchmarks are a really interesting point to look at, but people overvalue the importance on it for their own business.
So where would you say that people should go then? Obviously, consultants can help, but where, for many businesses that don't have access to that, where would you say is a good place for them to go to discover what is reasonable for them to expect based on their product or service?
Probably the best place to start is actually the industry benchmark, but don't take that one at face value. Translate that to understand like what is in that benchmark and how relevant is that for you. For online retail, well, let's stick with the agencies. For marketing agencies, maybe the benchmark is 50%, but if you realize that we're in this newer segment, or we are in a super specific, really high ticket, really high value niche, probably that industry benchmark we would have to adjust upwards. And whether you adjust it from 50 to 60 or from 50 to 70, that's your feeling based on your understanding of the market and also where you are now, because in the end you want to maximize it. So if you are now at 65, probably you want to set the target at 70 in that case.
Yes. I think that makes a lot of sense. One of the things when I'm talking with business owners that they really struggle with is identifying trends, because there are ups and downs in businesses. You have good quarters and bad quarters, but sometimes it's difficult to detect whether this is a bad quarter or this is the beginning of a big downward spiral. And certainly things like subscription-based businesses have helped level that out a little bit because you've got more consistent reoccurring revenue. But how do you coach businesses along those lines to be able to spot those trends early and not get panicked with seasonal changes or fluctuations or just, the quarter-to-quarter irregularities?
If the business has a couple of years track record, and usually that's our clients usually have that, you look at historic patterns. So if there's a certain seasonality, you can often explain certain changes from there. But you also look at the broader environment, what's going on in the other companies in the same industry. We compare with our other clients. You look at macroeconomic trends to get an overall picture. There is not a hard indicator that says, oh, if this one is happening or if this one is changing, that means there's going to be a recession. I think the world is much more nuanced than that. So to be honest, it's really hard to distinguish if it's just a quarterly dip with a logical cause that's not a cause to worry, or whether it's a long-term or fundamental shift. The one thing that I have noticed is that the sentiment, like the emotional, and that's of course weird for a finance guy to say that, but the emotional state of your customers, if you're in the service industry, is usually a good indicator on how long or how serious a certain change is. If they are optimistic and relaxed, then often it's not that bad. If they are getting jittery and I'm going to say almost in panic mode, then it's much more cause to worry. It's not a foolproof indicator, but it's a bit of a rule of thumb, basically.
Sure. Yeah, I see that in the stock market as well. They've got a volatility index, and you can look at some of that. And when the volatility is starting to go up, that can be a bad sign for the markets. And I think your answer from my own experience is kind of spot on. It's difficult to sense those trends, and I think that's partly why this COVID pandemic has been rough for businesses, because from a historical perspective, everything is off, right? The business just changed for many businesses so much. There's been government money flowing into businesses. They may have had to change their working environments, invest in new tools. So all their historic indicators have been thrown out of whack a little bit, because this was a very atypical year, right, for what's been going on. And hopefully we'll get through it, settle back to a more normal pattern. But I think it's been tough for many businesses this past year to see if things are going in one direction or another.
Ironically, I would say what you just mentioned about the stock market, the volatility index, last year was insanely volatile.
Right.
Again, looking at our client base, we've seen outliers on both sides. Nobody had a stable year last year. It went either up with 50% or more, or down with 50% or more.
Yes.
So it was incredibly outspoken, and that makes it, from our perspective, very interesting. But I'll be very honest, in a lot of cases, I was very happy I was not in our client's seats, because it has been insanely stressful.
Yes. Yeah, when things, we all like predictability, right? We all like consistency, and things moving in small increments one way or the other. When you have big wild swings, it can be absolutely very stressful. And I think we've seen that from a lot of clients. So, as we're sort of coming to the end of our interview here, I'd love it if you could just talk a little bit about how you engage with clients. What is sort of a typical good client for the kinds of services that you bring, and just tell us a little bit more about how people can find you and the services you offer.
Yeah. Basically, our ideal client is a service industry, so an agency between $500,000 and $5 to $7 million in revenue, where the owner is a content expert or a marketing expert and actively understands how important the numbers are, but doesn't have the full picture to use the value to scale their business. So we help them usually with dashboarding, KPI setting, analyzing, and like the whole management reporting side of it, and if needed, also with the bookkeeping side. The best way to connect with me would be through connectrob.com. And for new clients, we usually start with a game plan, which basically means we identify where do you want to go, what's your goal. We translate that into the KPIs. So what are the metrics that you should follow, and where do you want to, how can you measure the progress towards your goal? And what do you need to change in your books or in your reporting to actually allow for that information to be presented to you as the owner? And for the audience today, there is a discount, especially for you guys, on financeinsightmatters.com/virtual CMO.
Hey, that's great. I will make sure that we link all of that up in the show notes. Anybody who listens to this podcast regularly knows that I'm a big believer in bringing in experts to do what they do best, because I think that there are always areas, whether it's marketing, whether it's finance, or whatever it may be, where there's probably somebody that's a little bit more skilled than you are in that. And it's better to sort of spend the money wisely and get that expert advice than it is to struggle through something that may not be a strong area for you as a business owner. So Rob, yeah, it's great. I really appreciate the insights that you shared on the show today. Like I said, we'll make sure to have all your things linked up in the show notes. Thanks so much for coming on the program.
Pleasure to be here.